inflation. And the second part of the question is, you guys need to worry about money, not unemployment. Thank you.
So let me talk about the first part of your question, which was about inflation. So the inflation rate I'm referring to is what's called the personal consumption expenditure inflation rate, which is the inflation rate the Fed uses. That's a broader basket of goods and services than what's typically included in the consumer price index. It includes gasoline, includes food, includes housing, includes all these things. And when you look at that data, those measures will come up to right now averaging less than 2% on a year-over-year basis. I think there are prices that sometimes gasoline prices in particular are extremely volatile and they can move very rapidly, move up and down extremely rapidly. 2008 is a tremendous example of that, where total PCE inflation on a year-over-year basis got close to 5% in July and was down near zero towards the end of the year, just being driven by fluctuations in gasoline prices. That's why when we make monetary policy, we don't make monetary policy with the idea of trying to influence the inflation rate tomorrow. We're trying to look ahead 2 years. And these fluctuations in the gasoline prices generally are reversed over that time frame. So I'm talking about the forecast for inflation, including all the goods and services you try to include from 2 years down the road. In terms of the employment mandate, you know, I think in this proposal, I've really put, I think, a lot of, I share, I think, what's latent in your question, a concern that by not being sufficiently attentive to inflation, we would not be fulfilling our jobs as central bankers. And I think that's a very important part of the proposal I've put in place here, is that we will keep rates low, but only but there's a threshold that if inflation would ever exceed, this outlook would ever exceed 2.25%, we retain the optionality of raising rates at that point in time. I think it's important for us to offer guidance to people about how good economic conditions what kind of economic conditions they should expect to prevail at the time when we are contemplating liftoff. I think the unemployment rate is one way to convey that sense of what conditions will be. It's a number that most Americans can identify with. I could have tried to translate this into trend-adjusted real GDP or some more complicated measure that actually economists might feel more comfortable with. But I think an unemployment rate of 5.5% is something that most Americans can identify with as being close to being a return to normalcy.
Step, two-part question. First, what does the Fed do with the excess reserves on which it pays 25 basis points to the commercial banks? What, if anything, does the Fed do with those reserves in terms of possibly deploying them, or do they just sit there? That's the first part. And the second part is, in some future downturn, is the Fed likely to reverse the 25 basis point interest that it pays on excess reserves into a negative interest rate to induce banks, commercial banks, to do more lending?
So as the first part of your question is about excess reserves, those excess reserves are, as you suggested, they're excess reserves. So they're basically just sitting in the bank's accounts with the Fed at this point. The second part of your question was about do we retain the optionality of reducing the interest in excess reserves further below its 25 basis points? Yes. Could that go negative? I think right now the conversation is more about reducing it to be a positive value, but below 25 basis points.
Yes, sir. Just a point of clarification. One seems to be rather moving up. How does the Fed define unemployment?
Oh, okay. So to be clear, so both of the just to be clear about 2 points. One is on both in terms of inflation and in terms of the unemployment rate, as I'll talk about in a second. Those are numbers that are actually constructed by other by the government, not the Federal Reserve System. So these are statistics that are being measured by other branches of the government. So now the Bureau of Labor Statistics is who's charged with measuring the unemployment rate. So how do they go about doing that? They survey about 60,000 households every month, and they ask the household head, are you working? Do you have a job? And if you don't have a job, have you looked for a job in the past 4 weeks? Those people who answer yes to either of those questions are put together and called the labor force. Then the fraction of those people who don't have a job, those people in the labor force who don't have a job, that's called the unemployment rate. So the unemployment rate can fall, that means, arithmetically, for one of two reasons. Either because the labor force is staying the same and more people are getting jobs, or because the labor force is shrinking and the number of people who have a job is remaining roughly the same. Over the past 2 months, from July to August and then August to September, we saw both kinds of falls in the unemployment rate. So when the unemployment rate fell from July to August, it was because the fraction of people who were in the labor force, the so-called labor force participation rate, fell. From August to September, the unemployment rate fall was attributable to more people finding work. So so both kinds of, over a month-to-month variation, you can see both kinds of changes taking place. So that's, I guess, the answer to your question. I don't know if that was helpful.
Well, I mean, if the Feds expand unemployment, that sort of thing, it doesn't, I mean, you use that as a benchmark. How do you, is that rather a moving target and you just allow, I mean, I guess it's sort of fits the mold or whatever happens, I guess.
So I think the question there's two parts to answering what I think you're asking about. So the question you're phrasing is, can something that is so volatile really serve as a useful benchmark? And I'm sympathetic to that. I think that there are a couple of things to say. If the unemployment rate, the goal in this plan is to offer a vision that the Fed is planned to be fully supportive of an ongoing recovery. If the unemployment rate were to reach 5.5% relative to the current level of 7.8%, I would submit that we are getting much closer to being a normalization of labor market activity than we currently are today. The second thing I would say is that the plan is a threshold plan. What that means is that the Fed, when unemployment rate reaches 5.5%, the Fed could take into account a number of other economic conditions at that point in time, and to say, boy, things have not improved. Even though unemployment's at 5.5%, things have not improved as much as that would indicate. And so we can keep the Fed funds rate low, even though the unemployment rate has hit 5.5%. So these are thresholds for policy conversations that retain optionality. They're not triggers that trigger automatic increases in the Fed funds rate.
I would like you to give some comments on the national debt and how that could affect the two control mandates you're talking about, and could that cause it to become out of control, meaning inflation and unemployment?
Yeah, it's definitely true that over the longer haul, I think that there is a gap between the obligations that we've committed to our older citizens, and we're all going to be older at some point, and the taxes that we have on the table right now. That gap has to be closed in some way. Either it has to be done by cutting the obligations that we owe our older citizens, or it has to be done by raising taxes. Now, this is over the longer haul. This is not something that has to be fixed in 2013, but over a 10 to 20 year time span, this is a problem that has to be addressed. If markets do not see that the representatives of the people, Congress, are working on this problem effectively, then what you're going to see is that longer-term inflation expectations might drift upwards as a result. We're not in that situation now. And in fact, I think our Congress and the President have shown a great deal of assiduity about getting after this problem of starting to talk about a conversation, which is really a conversation that's going to be carried on over the next 10 to 20 years about how to address this gap between obligations and commitments and tax collections.
I have a ammunition? What does the Fed have left in its arsenal in any event of default in sustaining or regulating?
So I think my Liftoff Plan offers the arsenal you need. And so let me explain why I say that. If you say to people that you're planning to keep interest rates extraordinarily low until unemployment reaches 5.5%, as long as price stability is being satisfied, that is an automatic stabilizer against all kinds of shocks. Now, what does that automatic stabilizer mean? Suppose there's an adverse shock to the economy from whatever source, then and unemployment goes upwards. People will know going into such an event that the Fed will be keeping interest rates lower for longer, because now we have to take a longer time to get down to 5.5%. The Fed is automatically providing more stimulus that way. If the economy improves, what I hope will happen is the economy improves more rapidly than what we anticipate right now. Well, then people will realize, boy, interest rates won't be as low for as long as we think they are, and that will actually reduce the amount of stimulus the Fed is providing. So I think by adopting this kind of plan, the Fed can provide an automatic stabilizer, a shock absorber to a variety of kinds of good and bad shocks that could affect the economy.